In this week's video, we'll answer the question, how does 2014 compare to higher risk or pre-correction periods? If you'd like to look at these bullet points in more detail, you can pause your video player. We'll move through them quickly. We'll talk about risk-adjusted returns, look at observable bullish conviction, and what indecisive and pre-corrective periods look like, cover some short-term hurdles on the 60-minute DeMark chart, revisit momentum, the Dow's battle for a new high trends, risk on, risk off small caps, and we'll look at that long-term breakout chart for the broader stock market. To make sure that the broader message doesn't get lost in the charts, here it is. The big picture remains bullish. However, we need to see a few hurdles crossed and a few things cleared up. If that can happen, we're open to redeploying our cash. But for now, with the evidence we have in hand, a fence-sitting posture of stocks, bonds, and cash remains prudent. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We've got a lot to cover this week, so we'll be moving quickly. This is a 60-minute DeMark chart of the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies, LLC. First thing we want to look at is what's known as a TDST indicator. As we've discussed in previous videos, TDST lines talk to us about trends. This tells us that the 60-minute trend, as long as we remain below this level, which is 1869 and change, that the 60-minute trend remains down. So you can think of this as possible resistance. We went up and hit that line during Friday's session. The high was 1869 right at the line. We'd prefer to see the 60-minute trend break above that before we redeploy any of our cash. Now we're looking at a DeMark count. This is the aggressive combo count on the same 60-minute chart. Keep in mind we have the resistance that we just talked about. We have potential trend exhaustion with a 913 coming up right below potential resistance in the TDST line. And you can see recently in the other direction, when we had trend exhaustion here, there was a rally on the 60-minute chart. So this is another reason to be patient. If the S&P 500 can clear 1873 and change, it diminishes the probability that this 913 will produce a reversal. And in this case, the reversal would be in this direction. We also have some TD propulsion signals in force. What propulsion tells us is it speaks to momentum and targets. Basically says when you clear this level here at 1860, the probability of reaching this level here, 1848, increases. In a similar manner, if we clear 1848 in a bearish manner, the probability of coming down to the red diamond all the way at 1828 increases. This is my upper bound here. You can think of it as a target. It too comes in right at this TDST level. This teal diamond here, which is hard to see, is an upper level target. You can think of it as short-term resistance at 1869. Therefore, our upside potential during the session today near the highs was basically nothing relative to this teal diamond. And our downside potential, if we go to the red diamond, is 41 points. These are three reasons that we were patient at the close on Friday. All three of them may be cleared up on Monday, but we prefer to see that happen before we put more capital in harm's way. Before we move on to the concept of risk-adjusted returns, let's look at a few more things that A, said we should be patient at the close on Friday, and B, that we would like to see cleared prior to redeploying some of our cash. This is a daily chart of the Dow Jones Industrial average, you can see the recent closing high here is still in place, dating all the way back to the end of 2013. This is investor indecision and indecision about future economic outcomes. This level here is only a few points away and begs for some patience. We prefer to see this level taken out on a closing basis. You can see resistance, losses followed. Resistance, losses followed. We'd like to see what happens when we move back up here. We also have questionable momentum here. When Williams percent R fails to get back into overbought territory, often it tells you that you have weak momentum and some declines in the short run are ahead. You have weak momentum and declines in the short run are still ahead. So we'd like to see this cleared and this cleared. From a bullish perspective, slope of the 50 looks good and the slope of the 200-day looks good, and that is why we're willing to redeploy capital quickly if some of these short-term hurdles that we've just discussed can be cleared. Why are we willing to remain patient for the next 168 points on the Dow to get from this level here back to this level here so we can see what happens? We're not concerned about the next 168 points in the Dow. We're concerned about missing a 6% gain or something in the magnitude of a 15% gain. We don't know many things in the financial markets without any shadow of a doubt, but this is one of them. We know for sure that if we are going to move 6% from this level here to this level here, or 15% from this level here to this level here, the Dow has to clear this level first. So some patience remains in order. This is a long-term chart, monthly chart of the S&P 500 index dating back to 1995. Purpose of the exercise, slowing momentum. You can see here momentum is slowing as these bars begin to fall in 1998. If I come straight up here, this line actually isn't straight. A correction follows soon thereafter. Orange line, momentum on a monthly chart starts to slow and a multi-month correction follows soon thereafter. The bars start to fall, momentum is slowing. If I follow the line up, consolidation and a bear market. Our bars start to drop here with a slowing momentum in 2010 and a sharp multi-month correction followed here. Similar situation. The bars are rising. They start to fall here and a sharp correction in the stock market follows. We have falling bars now. We would prefer to see this cleared up before the end of the month. These bars speak to slowing momentum and probabilities. It may or may not lead to a decline. It's just something to be aware of. These market model objectives will put some context around the charts that follow. We like to place capital in harm's way when the odds are in our favor. We prefer to reduce risk and move capital away from harm when the odds become questionable or unfavorable. Our primary objective is to produce sleep-adjusted returns. This is the present day, April 17th, 2014. We're looking at risk on stocks relative to risk off intermediate term treasury bonds. This is the ratio here. This is what risk on looks like. Price above blue and red, blue above red, and the slopes are up. This is what risk off looks like. It's the mirror image. Blue below red, slopes down, and price below both. You can see we have a sideways look to this market, telling us that the battle between stocks and bonds has basically gone nowhere in terms of progress over the last 5 months. This is where we were at the end of last week. This is where we were 5 months ago. This is indecision here. What does a market look like when the odds are in our favor and it makes sense to put the vast majority of our portfolios into the stock market or into harm's way? This is what high conviction looks like. This is a full bore, bullish look here that lasts for several months. And this is a high probability period to make money in the stock market. This is the S&P 500, and this is 2012. You can see this high probability period here, stocks relative to bonds, looks absolutely nothing like the present day. This is a period here in 2011. Again, this is a high probability period. We have a full bore bullish look with stocks relative to bonds. This is a good time from an odds perspective to place our capital in harm's way, and indeed the stock market went up. You can see during this period here in 2011, we get a look that's a sideways look, and this looks very similar to the present day. Indecisive, our moving averages are tight, prices above, below the moving averages. Similar. The logical question is, what happened next? The answer, stocks corrected fairly significantly over a 6-week period. This period here looks similar to the present day. And after this period, here's the box, here it is again. This is what happened to the ratio. Bonds outperformed stocks, and the stock market here in black dropped 8 to 9% during this period here. Here's the S&P 500 here. You're just looking at this period from here to here. After the consolidation, stocks fell. Does that mean that stocks will drop out of our consolidation box that we have today? No, it doesn't mean that. It just tells us that the risks are higher, and until the consolidation box is cleared up, it can be cleared in a bullish manner or a bearish manner. We'd prefer to have a more mixed and balanced allocation. It's not just the stock versus bond charts that are concerning. It's also small caps relative to the S&P 500 weak lagged during the last 4 trading sessions. We prefer to see this cleared up. Gold is rolling over again relative to the S&P 500. This looks more like a deflationary environment. All things being equal, stocks do better when inflation is moving in this direction. All things being equal, we know that when the QQQ or technology stocks lead, markets tend to be healthier. This week, despite the rally, the triple Qs lagged, and we clearly have a downtrend in place. We prefer to see all 3 of these charts get cleared up in the coming weeks. 3 more charts that have some things that we would prefer to see cleared up. This is the S&P 500 as of the close on Thursday, April 17th. We have not made a new weekly closing high in several weeks. We closed below 1866 and 1878. We'd prefer to see a close and a higher high in this direction. Stocks relative to the aggregate bond market, again, risk on relative to risk off, still has a bearish moving average crossover, and despite the rally in the ratio this week, it has not made a higher high, and it remains in a downtrend. We prefer to see a close here, and better still, here. The NASDAQ, as we noted before, in a downtrend with the triple Qs. We also have potential resistance here at 4156. Potential resistance here, what once was support, may now act as resistance at 4103, and this trend line could also act as resistance here, and we still have a bearish moving average crossover in place. We noted in the opening slides that the big picture was still bullish. Here's a glass half full look. The broad market is still holding this breakout above 10,301. We closed at 10,532. As long as we remain above this level, all things being equal, that's bullish. This is the exact same chart that we just looked at, except this is the monthly version. It's a mixed bag. The good news is we're above this level. The bad news is this is an indecisive looking candlestick. We'd prefer to see this cleared up in the next 2 weeks. This is our weekly momentum chart of the NASDAQ. Last week we said that the odds of a bottom, a reversal, would increase if we could get a weekly close above oversold territory. Here, rally. Here we start to rally. It's rough. Here, eventually, we rally. We did get a close here, so this is good. That's the good news. The bad news is momentum is extremely weak, and it's possible that you can revisit oversold territory. So this is a mixed picture. We're still below the 22-week. That's the glass half empty. The glass half full is the slope of the 22-week is still up. We'll keep an eye on this momentum in the next few weeks. Same momentum concepts here with the S&P 500. Also a mixed bag. Momentum has bottomed and it's improving, but we did not retake overbought territory. So at this point, this is a relatively weak momentum move, and we would prefer to see it look more like this. Sometimes a weak momentum move can lead to a reversal. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.